What is going on, guys? We are back with another video, and today we are going to discuss the poor man's covered call, how you do them, how you make money for them, what are they, and why have I been doing them in my private Discord group so much recently. Well, let's get stuck into it and I'll show you. So I have thrown together this really shitty PowerPoint. You guys are going to have to deal with it. My PowerPoint making skills are simply not there, so let's get stuck into it, and you can judge it in the comments. But I don't want to be hearing no shit about it. Right, anyway. Enough of the funny talk. How to poor man's covered call. Let's start this slideshow. Here we go. How to poor man's covered call. How to enter a poor man's covered call. Okay, you want to buy a leap option. Right, which is, I like the class a leap option for my covered calls at least 3 months out, up to 6 months out is best, but I usually go about 400 days out if possible, because I like time. I don't mind paying the extra capital for the long call as long as it makes the trade safer, okay? Which this in turn technically does. So make sure it's about 3 to 6 months out plus. And make sure the call you're buying is at least 0.7 delta or higher. You want a higher delta on the call that you're buying. Yes, the higher the delta, the more expensive the call is going to be. However, if you end up buying a long call with a delta too low, you can actually lose out in the long term on this position, even if price goes up too high. And I'm going to show you exactly why in this example right now. So let me tab out of this shit and we're going to go to option strat. Where the fuck is my Google Chrome? Oh, I'm on Google Chrome, that'll be why. So we are going to use a very quick example here of how this works. So in this example, this is the example I'm going to discuss later on as well, but I just want to show you what I mean about this delta value thing. So as you can see right now, if I was to sell a call or buy the call, if I was to buy my leap call with a delta that was too low, let's say I went for the 50, well, you can see what happens. You know, the lower the delta, the lower you bring this delta, the more chance you have of losing if the price goes up because of the two different delta differences. Okay, so as you can see, if I was to bring this right up to pretty much at the money, you can see what happens. Then you can really start to lose as the price increases. Okay, or the higher the delta you go, it simulates a covered call more, so the profit cap is more flat at the top, and it's a lot nicer of a simulation that way of an actual covered call instead of what we're doing, which is the poor man's covered call, because we're poor, we're broke, we don't have the funds to buy 100 shares of this. So this is the way we're doing it, right? Okay, back to the PowerPoint. Okay, how to manage it. Some points for management, okay? Keep in mind how much extrinsic value is left on the short call before you're rolling. Okay, when you're rolling these, we don't really want to have to pay back any unnecessary capital whenever we're buying it back, because we want to collect as much premium, bring as much premium in through the door as possible, because we're greedy bastards. We love money. We want to keep it collecting and collecting and collecting. Okay, we don't want to have to pay any unnecessary stuff back. If the short leg gets challenged, which is obviously the call that you sold in the shorter time frame, there's a few things you can do. Number one is you can roll for a credit. We don't want to be rolling these for a debit. We want to roll for a credit. We want to roll for a credit, bring more cash in the door, because it did say we're greedy bastards. It is what it is. We want money. So we're going to roll for a credit and ideally push the strike out a little bit if possible. So that means we have a little bit more leeway and we can capture some more capital appreciation in the process. Or what I actually prefer to do with my per man cover calls trades is close the trade out for a profit. If your short call gets breached, happy days. You wanted the stock to go up anyway. You've made your capital appreciation. Close the trade out and you're done. Move on, find the next. Okay, that is my ideal method for managing these. Okay, there's actually a little trick that you can do though, with a call credit spread. So instead of buying, or instead of selling your covered call, what you can do is you can actually sell a covered call credit spread. Now what this does is this is a very good idea if you're ultra bullish on the underlying asset that you're doing the per man's covered call on, because you've bought protection for your covered call, which means you can still collect the premium on your leap option. Obviously you're not going to get as much premium because it's a covered call, but you can still collect that premium. And if the underlying moves up heavily, very fast, and challenges your short call, then the long side of that credit spread is going to be in big profit. And you can actually close out that call. You can actually close out that long call for big profit, which will increase your break-even price, which will bring you in more profit. And then the short side of that will just act as your covered call that you were normally going to have anyway. So only if you're ultra bullish, so because if you're not, you may as well just sell the covered call because we want to collect as much premium as possible. Okay. Ignore the shit graph here. This is as best as I could come up with because nobody would help me. I asked for help and nobody would help me try and design these, so I'm going to have to do a lot better in the upcoming videos. But here we go. So this is an example of a per man's covered call on IBIT, and where I like to place my strikes, and where I like to place the deltas. So I'll get the broker up here in a minute as well, and we're going to actually look at this live and see what it is. So what you can actually see is at the top here. Oh, I've got my mouse. Okay, so on this side, you can see we have the strike prices of IBIT, and here you have the days to expiration. So for the leap option that we bought, we paid $2,680 for a 406-day expiration, 40 strike long call with a 0.8 delta. And on the sell side, our covered call, we actually sold the 60 strike, 7 days to expiration. So you can see for a 406-day call, we pay out $2,680, but for a 1 week, we're collecting $100. You could obviously go more aggressive if you want to increase the delta of the short call. But for me, this is a nice setup. And I'm going to show you exactly what that looks like right now on the broker. So what you can actually see is if I go out, this might be kind of hard for you guys to see, but I'm sorry about that. So if I go out 404 days and we scroll down here, you can see here's the 40 cost. We're buying the 40 call leg. And then if I was to go 5 days out, and technically it's the weekend, so it's still a 7-day contract. We are going to sell the 60 right here, and you can see that brings in 100. So now the break-even price is 25.08. Now, break-even tracking. How do we track the break-evens on these? Because this is crucial. I can't get it into your guys' heads enough. You have to track these break-evens properly, or this will not work. Especially when it comes to rolling these positions and trying to work out your break-even price on the leap option. So let's get off this shit, and we're going to go to a profit tracker that I've created for these. Again, it's not the best, but it'll do for this situation. So we're going to enter this trade in together, exactly how I would actually enter this, and we're going to pretend we have just taken this IBIT per man's covered call, and then we are going to profit track it, see how this goes. So the first thing we're going to do is we paid for the, if I take off the covered call side, we paid 26.8 debit. Okay, so we're going to put 1 because we paid. Position to open was the 40 call, and the expiration date on that one was January 16th. Oh, help if I was typing. 26, okay. And then we are going to, right here, put in what we paid for it, which was 26.8. Okay. And then that means, so right now, technically, this entire position is at a loss of 2,680 if you're just looking at it in terms of how much money we've brought in and how much money we have given out. But we're not going to do that. What we're going to do is, because the leap option isn't closed yet, we're going to put that as right at the same, so that means it's 0. So right now, this position is at 0, which means the break even, in fact, I should probably zoom in for you guys. So which means the break even right now is 26.8. Okay, that is our break even, and there's today's date, because that's obviously we're entering it today. So now let's sell our covered call against it. So we're going to copy this, we're going to paste, and we're going to sell the 60 call. And we are doing that for the expiration date of the 13th. And we were going to receive a credit of 1 for this. And ideally it expires worthless. And both these are still open. Oh, it's -1. Both of these are still open, so we're going to mark them with a yellow so we know that. And we're going to dollarize this. Okay, and then we're going to take away, just trying to tidy this up a bit for you guys. Okay, we'll dollarize that. Okay, so now our new break even, 12/8, and our new break even is equals 26.8 minus 1 credit, because that's what we received. Done. Our new break even on the leap option is 25.8. So we have now only paid 2,580 for that leap option. Okay, but this keeps getting better because you keep doing this and doing this. So let's say this expires. Let's say there is a pullback in IBIT, and you can close this out for 0.2. 0.2. Done. Well, your break even is now that plus 0.2. There's your break even. Okay, and we're going to, there you go, 26, right? 26 is exactly your break even. So next, what we're going to do is we're going to sell another covered call, obviously, because that's what we like to do. But let's say for example we want to go out a month this time. Okay, then what we could do is we go back to the broker, and we would simply go a month out. So we're going to get rid of, oh, there's all my covered calls. We're going to go 33 days out, and let's say we sell the 60 again. Well, right now we're getting paid $3.8 for it, so 380. So we're going to go 60, and then the date that we put in for that is going to be the 10th of January 2025. So we're going to go -1. We're going to go 60 call again, and obviously that one's closed, so we take away that. We're going to go, what day was that again? Sorry, the 10th. So we're going to go 1/10/25. And the credit to open was 3.6. We received 360. Just copy that, paste that. $360. There you go. So 3.6. So now we've just collected $360 on this per man's covered call. Okay. So then let's say it was a week later, obviously. So the week after that would be, that was the 12th. The 19th, so let's say on the 19th. Sorry, your dates are the American dates are the wrong way around. So it would be 12/19, and the new break-even price would be equals 26 minus 3.6 equals. So now you technically only paid $2,240. For that. And then let's say this gets assigned. Okay, let's say this gets assigned, it goes in the money, and let's say it goes in the money by, I don't know, like $1 or something. What you would do is you would close this for 4.6, which means you'd lose $100 on this. However, this would be at huge profit. This would be at profit of, let's see, if we go to option strat and we close that, and let's say because that was in the money by $1, we're gonna try, and the expiration date was on the 19th, wasn't it? Let me see. The 10th of January. So we're gonna go 10th of January. January 10th. And so in this example, our 60 call went $1 in the money. So if our 60 call was $1 in the money, it would be at $119 in profit. So if we paid 27 for that, let me say no, $61. Sorry, $61 because it went $1 in the money. 200 up. So that means if it was 200 up, 26, 27, 28, we'd be closing this at 28.8. And in this example right here, you would have made $260 just on this per man's covered call. Okay, so I hope that sort of explained a lot to you guys. I know that was kind of complicated at the end, and it was a bit of a fucking free-for-all because I don't script these videos. I can't be bothered with that. I probably should. But that was an example of the per man's covered call on IBIT. If you have any questions on the per man's covered call, please drop a comment. Please join the Discord group. Always remember about the Discord group. In here, as you can see, we have here's the testimonials. Everyone seems to be very happy. Everyone's making money. If I go to our closed trade section in this group, trade history, here was my weekly recap. All signals provided for you guys in the group. I had 19 wins, 0 losses, and 1 roll. The week before that, I had 11 wins, 0 losses, and 0 rolls. Guys, come on, join. Link in the description. Great price, very, very cheap. And there's a free section as well with some free trades too. And not only that, you're getting access to Jen's 1DTE SPX trades, which she has a proven track record of profitability. She's making thousands of dollars a week doing that. So I hope to see you guys in the group. And thank you for watching. I'll see you in the next one. See you later.